We have now a couple of presentations about the economic outlook and about issues around growth, and then afterwards a discussion among the business leaders here in a round table format, and you sort of get to, after that you should be able to get to ask some questions. But I introduce now Vladimir Dlouhý, who is the International Advisor of Goldman Sachs and Professor of Macroeconomics and Economic Policy at the Charles University in Prague. Thank you.
Thank you very much, Chairman. Good morning, ladies and gentlemen. First of all, two introductory remarks. First, I thank Ambrosetti to giving me and my other colleagues the opportunity to present here, and I will do a brief economic outlook as a framework for the next discussion. And second, half seriously, half jokingly, well, I also would like to thank my Ambrosetti colleagues that they accepted that I'm kind of an exception from pro-European bias within this group, but not too serious one.
Nobody's perfect.
Nobody's perfect, of course. So let me move ahead. The year 2012, by any means, is a difficult year. We are living through the after effects of 2008-2009 crisis. We see in all advanced economies fragile recovery. We obviously see much higher but very differentiated economic growth in different emerging market countries or regions. Since May 2010, we have seen the euro crisis, and despite some recent positive news about the elections in Greece, still we cannot say that we see a sustainable solution on the horizon. And obviously, last but not least, we must judge very seriously the impact of euro crisis on the world economy, but also on the other economies within European Union outside the Eurozone. And needless to say that the whole Europe is probably passing through the most difficult reconsideration of the European integration since the end of the Second World War. Where are we today in June 2012 in euro area? And I'm stressing June 2012 because the work of the analysts and economists, macroeconomists in general, is quite difficult because the situation is changing very quickly. In terms of the data, as it has been said by our chairman, I'm working for Goldman Sachs, and I'm using heavily the analytical background provided by our research department, but these figures might differentiate slightly sometimes, especially the short-term forecast from other figures, but they are in the mainstream of thoughts. What you see in the first slide is the recovery in the core of the Eurozone, but continuing a recession in the periphery. On the box, I hope that it can be well seen, and also on the handout, we see the differences for the Euro area in total. We see expected a slow stagnation or a negative zero growth, as we call it, and the differentiation between Germany and France on one side and the largest two peripheral economies on the other side. We see the long-term borrowing cost diverging significantly. Germany and France seeing stagnation or some type of the recovery, especially in Germany, but quick surge of the long-term borrowing cost both in Italy and Spain. This is also very well reflected on this picture, which is, while the previous chart is well known, this is not such a well-known comparison. Here the gray line is the long-term trend, which fits the spreads of both Italy and Spain towards the 10-year bonds, and you see the huge divergence of the actual spreads in recent years from the long-term trend being fit. This basically shows that both Italy and Spain, the two largest peripheral economies, are passing through the very difficult periods in terms of financing their debt compared to the long-term trend. Again, comparing to Germany, the general indices for the financial conditions are tightening or are differentiating, tightening, especially in Italy and Spain. Even worse situation seems to be for the small and medium enterprises, where you see the difficult situation here. And no substantial correction of the basic macroeconomic imbalances so far. Yes, you can discuss whether the unit labor costs in the long term are the best description of the development of the competitiveness. The graph on the right-hand side of the slide is well known, as is well known the situation of the left-hand side, the German current account surplus compared to the current account deficit in the peripheral countries. But the main message is, whatever the interpretation is, that there is not a substantial correction of these imbalances so far. So to conclude, as I said at the beginning, on the periphery, we can expect the recession to continue, while in the core economies we see the recovery, despite the fact that the year 2012 will be the year of the general slowdown of the economic activity, which obviously does not improve the overall environment and climate, including the social and political climate in the whole Eurozone, because after the post-Lehman crisis back in 2012, we have expected negative growth in overall Eurozone once again. And as we have seen, there are inside the Eurozone strong differences, which are given by the austerity measures and the tight financial conditions. Imbalances persist, inflation is too low, and the adjustment is too slow. There is no, as I said, improvement on the horizon. The core of the problem is probably best reflected on this slide, that Eurozone is embarked on a vicious downward cycle. I feel sometimes, Mr. Chairman, a little bit uneasy because I'm not from inside the Eurozone. I'm even from the former communist economy, which only 20 years ago joined the club, and I'm teaching about the Eurozone imbalances. And on the top of everything, I'm Czech. Which is a kind of a feeling that we are more Eurosceptic than the others. But anyway, I hope that it works. If we start from weaker economy and we go to the right-hand side, that generates both lower nominal GDP and lower tax revenue, which deteriorates government debt-GDP ratio, which increases government default worries, which leads to the higher government bond yields, which increases the bank solvency and liquidity concerns, and generates more banking and financial strain, and it might lead to reduced loan supply, which adds to the weakening of the economy. But we can go to the left-hand side, starting from the weaker economy, which increases the fear of the loan losses, generating again more strain on the banking and financial sector, which obviously increases the expectations about bank rescue costs, leading to the higher government bond yields, higher debt service, which again increases debt-GDP ratio, which calls for fiscal tightening and undermines the aggregate demand and ends up in the weaker economy. And the question is, how in the short term stabilize the Eurozone, and how and where to break this vicious downward cycle. I'm going to argue in a minute that it has been, this vicious downward cycle has been at the beginning of 2012 broken by ECB, but let me come to that, as I said, in a minute. Let me theorize for really a very short term. There is a common wisdom that Eurozone is not an optimal currency area, and we have different conditions. We have for a group of countries to form an optimal currency area: good market integration and monetary standard, factor markets integration, financial market integration as a risk-sharing device, the existence of the fiscal transfer and fiscal discipline defined or imposed on all the countries forming the optimal currency area. Another condition is flexibility of the markets and structures to adjust to shocks. And last but not least is the political institutional integration. This has developed since the seminal articles of Robert Mundell at the beginning of 1960s, and then subsequently several economists added a different angle to this. The crucial issue is, where is the fixed point? Is the fixed point, as the founding fathers of the Eurozone expected, the imposing of the single currency, or is the fixed point the existing structures? The second point, or second question is, are the optimal currency area criteria complements or substitutes? In other words, is it enough to impose one of them and the others are going to adjust or not? And the third basic question is the endogeneity of these criteria. Will they adjust on their own, or is there a need for the policy actions? And what is the role in the markets in this adjustment, as we unfortunately see recently that markets can even lead the adjustment in the short term in the what I would call a perverse direction. As I said, the founding fathers of Eurozone believed that the fixed point might be imposing of the common currency, and the structures are going to adjust. Recent experience shows, unfortunately, the opposite, that primary importance are the structures and structural changes, that the optimal currency area criteria are more complementary than substitutive, and that in the short term what is needed is stabilization of the markets, because they might lead the adjustment in the perverse direction. If you want to achieve a sustainable solution, you must respect points A and B above. Current measures concentrate more on the C, on the stabilization of the markets, which is going to bring mainly and only short-term effects, be it the different stabilization funds, external IMF support, and a very important thing since January 2012, essential ECB long-term refinancing operations, LTRO. And here let me go back to the vicious circle. Basically what LTRO did, ECB, that it has broken this vicious circle in this particular link between bank solvency and liquidity concerns and expected bank rescue cost. On the next two slides, or next basically 2-3 slides, I'm providing very quick illustration how LTRO arrested vicious circles by the bank supports. On the left-hand side, on the upper part, you see the description of the high funding needs of the banks, and then you see how a long-term refinancing operation increased the ECB financing to the banks, stabilizing a little bit bank loan flows, as you can see it on the left-hand lower part graph, but the stabilization is on quite a modest level. And you see some kind of declination of the funding costs for the banking sector after LTRO, despite the fact that recently we have seen only different development again. And it also provided some relief to the sovereigns, especially back in February, March, April. Since May, it got again worsened. On the left-hand upper chart, you see very high funding needs of the government comparing the expected redemptions and issuance or the reality in the past. And you see how the funding situation on the lower charts has eased after LTRO, but intensified, unfortunately, again in the recent weeks. But as I said, LTRO is basically, despite the name, long-term refinancing operation. It's a measure directed towards a short-term stabilization, at least according to my humble from outside observer. I believe that this is not a remedy for the long-term solution. And it's not free of charge. There is no free lunch here. As we can see, at least on these two graphs, on the left-hand side, you have the so-called target 2, which is now quite a fashionable parameter, which is being displayed. It basically shows the overnight balances which are being followed by the ECB on the intra-Eurozone transfers. And target 2, basically, the picture of target 2 resembles the the chart of the current account surpluses for Germany and current account deficits for peripheral economies, but this obviously reflects flow of funds. And at the same time, you see how monetary and financial institutions, except the euro system, change their holding of government debt securities. You see how on the right-hand side picture how it was till the end of, or till November 2011, how it has increased substantially since then. And I do not have the May figures. This finishes with April. And despite the fact that euro area, especially now after some at least short-term stabilization by ECB, has the capacity to address the fiscal issue. As you see on the graph, the general government debt for 2011 and continuing 2012 is on the absolute figures incomparably lower than that of Japan, but even lower than the US and comparable to the UK. The same applies for the comparatively low deficit, but as is well known, there are large cross-country differences, and obviously the governmental weaknesses in terms of general government debt make this consolidation much more difficult. And these are just some illustrations generated by econometric macroeconomic modeling. It shows that the adjustment, ceteris paribus, other things being equal, in the peripheral economies will be extremely difficult. And please do consider this figure with a certain kind of a reservation. It's only a macroeconomic modeling, but the current account deficits in Greece and Portugal is now between 12 to 20%. Should improve. In Spain and Italy, it should improve by some 7 to 12% within the next 10 years. The real exchange rate in Greece, Spain, and Portugal should improve or should change by some 25 to 40% within next 10 years. And even under a realistic growth assumption, to get, for instance, the Spanish or the Portuguese debt under 80% of GDP no sooner than in the year 2025, which is in more than 12 or 13 years, which implies strong austerity measures or the expectations by much higher growth. And behind this macroeconomic model, already some relatively, from today's point of view, optimistic assumptions about the future growth, about 2 to 2.5% per annum is embedded. And this, despite the fact that I do not take these pictures too seriously, because they are just the macroeconomic modeling ceteris paribus given the today's situation, and in the long-term situation and the macroeconomic conditions might change substantially. This still brings home my main point, that I am not a believer in some kind of a silver bullet solution. I am not a believer in the short-term measures. I am strongly convinced that Eurozone will go through very painful and difficult economic, social, and maybe a political adjustment, and I am a strong believer in the long-term structural changes. I do not want to discuss here whether Germany should more relax its macroeconomic policies or not. This is not a framework for the Ambrosetti subsequent discussion. If there are the questions, I will be happy to say my own view. Running out of the time, coming from the region of Central and Eastern Europe, only a few words to that, because it's a region which always when there are some disbalances and problems within the core Eurozone country, many analysts and forecasts expect that this region is going to be very severely hit. And despite that some parts of my region, especially the Baltics and Hungary, were severely hit by the post-Lehman crisis, never we have witnessed that apocalypse that some analysts expected. Needless to say that anyway, even for us, the year 2012 is going to be very difficult. Some of our economists, namely Czech, Hungary, and Slovenia, will probably pass either through a recession again or almost a recession. But we have, with the exception of Hungary, we have strong points. Comparable, more macroeconomic stable compared to the peripheral economies. And as the Lithuanian and Latvian example showed, we seem to be politically and socially less sensitive to short-term adjustment impact, at least for the time being. And because I'm running out of time, indeed, you will see on the next couple of pictures, you will see the development of the GDP growth, fall in 2009, and unfortunately slowing down again in 2012. The red are the countries with a floating exchange rate, blue are the countries with the either fixed exchange rate pegging to the euro or embracing euro already. Development of public finance deficits in a rather difficult situation, but improving, with the exception of Hungary, quite stable public debt or the public finance sector debt GDP ratio, and even Hungary is stabilizing, and current account deficit seems to be fully under control. And to conclude, I just provide our Goldman Sachs short-term basic forecast for GDP, CPI, current account, and budget balance. So to conclude, ladies and gentlemen, I believe that the years 2012, 2013 are going to be difficult years with a very slow economic growth. Peripheral countries are going to struggle substantially. We have the morning after a relatively positive result of the Greek election, which might lead to Greece remaining within the Eurozone, but in the long term, structural changes, improving of the competitiveness and improving of the productivity within not only Eurozone, but the whole Europe is essential. And that brings me to the Ambrosetti goal for this seminar this morning. Thank you very much.
Thank you.